Have you ever wandered through a flea market and spotted something incredible? A vintage watch, a first edition book just sitting there, covered in dust. Everyone else walks right by. But you? You know it's worth 10 times the price on the tag. What if I told you that the entire stock market is just like that giant, chaotic flea market? And that the wealthy, the legendary investors, they aren't using some secret, high-tech algorithm. They're just the best bargain hunters. That, my friends, is the heart of value investing. So, what exactly is it? Let's break it down. Value investing is an investment strategy, a mindset, where you aim to buy shares of a company for less than their intrinsic value. In simple terms, you buy $1's worth of assets for 50 cents. It's not about chasing hot trends or betting on what's going to be popular next week. It's about being a business owner, not a stock speculator. The entire philosophy rests on three fundamental principles. Think of them as your treasure map. Principle number one: the market is a moody voting machine in the short term, but a weighing machine in the long term. This genius idea comes from the father of value investing, Benjamin Graham. In the short term, stock prices are crazy. They swing up and down based on news, emotions, and hype. It's a popularity contest. A company can be doing great, but if the news is bad that day, its price might tank. That's the moody voting machine, but in the long term, the truth always comes out. A company's real worth, its earnings, its assets, its profits, eventually gets recognized and reflected in its stock price. That's the weighing machine. Our job is to ignore the mood swings and focus on the actual weight, which brings us to principle number two, the margin of safety. This is your golden rule, your safety net. You never, ever pay full price for your estimate of a company's value. Why? Because you might be wrong. Let's say you analyze a company and decide it's truly worth $100 per share. A value investor would only buy it at a significant discount to that, maybe at $70 or $60. That $30 to $40 difference is your margin of safety. It's your buffer against miscalculations, bad luck, or a sudden market downturn. It means you're protected even if your analysis isn't perfect. And finally, principle number three, know your business. You wouldn't buy that flea market watch without checking if it works, right? Same here. You must understand the company you're investing in. This is called fundamental analysis. You need to look under the hood. Look for companies with strong financial health, low debt, lots of cash, consistent earnings, a history of being profitable, a durable competitive advantage, sometimes called a moat. Is it a beloved brand like Coca-Cola? A tech giant with a network effect like Apple? Something that makes it hard for competitors to catch up? When you find a company that ticks these boxes and it's selling at a discount because the market is in a bad mood, that's your signal. That's your dusty vintage watch in the flea market. So, to recap, be a business owner, not a gambler. Exploit the market's mood swings to buy wonderful companies at a discount, always with a margin of safety. Ready to become a master bargain hunter? Here are your external resources to dive deeper. First, go to the source. Read The Intelligent Investor by Benjamin Graham. It's the Bible. Then, devour the shareholder letters of Warren Buffett's Berkshire Hathaway. They are free, brilliant masterclasses. For online resources, check out the Value Line for solid data and websites like Guru Focus or Morningstar for in-depth analysis. And of course, the U.S. Securities and Exchange Commission's EDGAR database is where you can find every company's official financial reports for free. The path to becoming a successful investor isn't about being a genius. It's about being disciplined, patient, and always hunting for that dollar you can buy for 50 cents. Now go out there and find some treasure.